Welcome to the Roetzel HealthLaw HotSpot. HealthLaw HotSpot is a podcast for physicians and health professionals that covers the legal issues and trends that affect the healthcare industry.
Hi, everyone. Welcome to the HealthLaw HotSpot. My name is Ericka Adler, and I am a shareholder at Roetzel and leader of our healthcare practice. Today, we're going to be talking about a great topic, which is the tax-related proposals that are out there targeting high-income Americans and which are currently included in the Biden administration's Build Back Better agenda. For those high-earning professionals out there, doctors, dentists, and other types, you know that you're waiting to find out what's going to happen and how this might impact you since you fall in that high-income category. So today, to explore this topic, I'm joined by David Hochman, who's a shareholder and part of our health law practice at Roetzel and I'm also joined by Damien Martin, and he's part of BKD Private Client. So Damien provides tax compliance, consulting, and planning services to individuals, families, and fiduciaries, and provides proactive succession planning for high net worth individuals and their family-owned businesses. As the CAS region leader of BKD Private Client, he also focuses on helping high net worth clients build and preserve their family's legacy through an integrated suite of services designed to assist families to manage and transfer their multi-generational wealth. So thanks for joining us today.
Here.
And I know from talking with you that you're just the person to kind of take us on the journey through some of these new proposals that are out there. And what David and I really want to talk about is how are our clients who are listening to this potentially going to be impacted? When can they expect to see some of these proposals coming to fruition? And what should they be doing to prepare? And who should they be talking with to make sure that they've got, the right advisors around them? So welcome. Thanks for joining us. And we can't wait to explore this topic with you.
Oh, thanks for having me. It's good to be here.
So why don't we start off with you just letting us know a little bit about this proposal that's out there and maybe what some of the key terms are that our listeners need to be aware of.
Yeah, I think probably the key thing to mention out of the gate is even how you tee it up, right? That what we're talking about here is proposed. And as you go through the legislative process, it's a negotiation, it's a conversation, it evolves, and everybody sort of has their own take and their, what they want for their own districts and their states, their constituents, right? And so we're kind of at the front end of that, but we've been really closely watching this for probably the better part of a year as we started to see the change in with the Democratic control in Washington. We knew that the Biden administration had some, what they had campaigned on, really some bullet points around what we might see. And so there's been a lot of conversation, a lot of planning that's been building up. And we saw a lot of that in the early part of the year with some of the details being released. We even saw what's known as the Green Book, which is where Treasury released a little bit more detail on those bullet points from the Biden administration on what this might look like. And really and this is where I'll focus right now, and this is where I think everyone should be focused. The most recent update is back in the middle of September. We had House leadership on the Democrat side release their legislative text as to what this would look like. And the vehicle that this all fits under is something known as budget reconciliation, so that it can get through the Senate, which has the narrowest of narrow margins that you could possibly have, which is a 50-50 split, but then have the Vice President Kamala Harris able to give the tie-breaking vote. So that's where we say, okay, there's Democratic control in the Senate. And I should probably mention at the same time that while we have Democratic control in the House, it's also very, very narrow as well. So basically, you're trying to thread a needle to get all these proposals and these ideas through, and you need to pay for them somehow. And that's where some of these tax changes come into play. So back to what I was saying about middle of September 13th, we had this legislative text released. And then in there, that's where we saw some similarities to what the Biden administration was proposing, as well as a number of, I guess, things that maybe surprised a few people and some differences. So maybe I'll unpack those if that sounds good.
Sounds good.
All right. So I'll start on the income tax side of things. And kind of broad strokes, high level, what I'd say is that the rate on ordinary income for high income taxpayers is sort of the defined as $400,000 of income. And that's a number that, again, has been sort of been floated around since the campaign days of President Biden. And so a lot of these income tax thresholds all look at that. And so what we'd see is once you get over that $400,000 threshold, you start to see the top ordinary rate on income go up to 39.6%. It's currently 37%. And by the way, it was 39.6% before we had the last round of tax reform a few years ago in 2017. So we kind of be returning back up to that. That one probably wasn't too surprising. I think a lot of people were maybe expecting that. But what we also saw were changes to the net investment income tax. And that's a tax it's 3.8% on certain types of income. Right now, it's generally investment income, as the name implies. And it's for those over, well, it depends on what type of filing status you have, but we'll say $250,000 of AGI. And so that 3.8% right now only applies to investment income. Well, they would change that and say, okay, well, we're going to include, unless you pay self-employment tax already, we're going to include active businesses as well. So basically, if you're sitting here today and you say, okay, I was paying 37% on my income, you now would have, you go up to 39.6% if you're in the top bracket. That top bracket also would start to kick in sooner. And then you layer on 3.8% because maybe you're set up as an S corporation and you're not paying self-employment tax or net investment income tax. You're adding that. And if your income gets above 5 million, there would actually be a 3% surtax added on top of that. So you'd be adding another 3% on top of that. So you can see the top rate goes up quite a bit. You get up into the upper mid to upper 40s. So you'd be in about 46% range there on the top rate that would be possible. So the takeaway probably is, and there's a lot of nuances, there's a lot of things we could dig into, but the top rate on ordinary income, so income earned from the practice, would be going up. And I'll make one more, I guess, to mention on the income tax side, and that's the capital gains rate. And that's had a lot of people, it's got a lot of people's attention. And I've been having a lot of conversations around that and planning for it, whether it's from a mergers and acquisitions side or just, investments and things that are held and maybe harvesting or targeting some gains. So what we would see under this proposal, this is the House version, again, mind you, that we would go from the current 20% rate up to 25% when you're above that $400,000 threshold. Of course, the net investment income tax would apply. So a lot of times you say right now the rate is 23.8%, right? Well, we'd be going up to 31%, 31.6%, because you'd be going up from, you'd have I'm sorry, 31.8%, get my percentages right here, because you'd be layering on the extra 5% over 400, the net investment income tax, and that 3% over 5 million. So your top rate would be going up quite a bit as well for capital gains transactions. And the proposed effective date was actually September 14th. So if that were to get enacted, that already happened. And the significance there is they always generally peg those sorts of things to the date the text gets released. Since it got released on September 13th, it was the day after. So it's possible that could change. That's the number one question I always get is that capital gains rate going to stay? And is it going to stay with September 14th effective date? It might, but the next step is, if it can get out of the House and it moves forward, it'll go over to the Senate. And there we might see the Senate Finance Committee introduce their own version, which is kind of common. And so then we may see a different date there. So maybe back to your question as to, because I don't want to miss this point. It's proposed, right? But when might we see it? Well, they're targeting the end of October to get it all done. I think probably, again, this is me talking from my perspective, it probably slips into November or December before they can get it done, because there's a lot to get done and a lot to reconcile, and they're not quite on the same page yet in terms of what would fit underneath that. So that was a lot, but basically rates are going up on the income tax side.
Wow.
So Damien, if this drags on to the end of the year, do you think it's more likely that they'll push the effective date to 2022 on the change in rates?
I think that it certainly becomes more likely, Dave. That's a great point. Really what they're kind of wrestling with on the capital gains rate side is, and I should back up and also say the ordinary change that is proposed January 1, 22 effective date. It's only this capital gains rate and a few other little changes that have this date that would be earlier. And the thought there is, well, if they tell you today that the rate's going to go up on January 1, 2022, well, maybe then, if you had your shares of Apple that you've been holding on to forever and you got the gain, you say, well, you know what? I'm going to lock in my rate now and I'm going to sell it. And well, then maybe that creates a market sell-off and nobody wants that. So the logic behind it is, okay, we'll do it today. And, that way it doesn't maybe create some of that sell-off. Now, it's certainly not popular from a political standpoint to have a retroactive deal, but they certainly can do it. Originally, they were kind of talking about an end of April effective date. I think that's gone and out the window. I don't think we see that. But as we get closer to the end of the year, David, I do think that the chances that it goes out prospectively come a bit higher.
Yeah, the reason I'm smiling, I had a call this morning with a client who was gifted stock when he was young and has dividend reinvestment, and he has a huge unrealized capital gain.
Yeah.
And he's trying to figure out, should he sell this year or not? So he wants to know, well, what's the effective date going to be?
It's a magic question I've been asked a lot of, and I always say, my crystal ball is unfortunately probably only as good as yours is.
Right.
I certainly pay attention and try to listen to what people are saying. And it seems like they do think that some sort of a retroactive date, that people can get behind it. The rate now is kind of where they think they can get behind it, because originally under the Biden proposals, it would go up to the ordinary rate after $1 million of income. So it's certainly much lower. So I think we get there. But to what I would say is maybe it actually, we're in this situation. Let's just assume that what is introduced in the House, and by the way, was approved by the House Ways and Means Committee on September 15th. If that were to actually move forward and get enacted exactly as it is right now, if your gain is going to be of a substantial amount, and your income is going to be over that $5 million threshold where that 3% kicks in, well, that 3% actually doesn't kick in until January 1st of 2022, again, if it gets enacted. So you're really in this spot where, okay, maybe it's now 5% more expensive than it was on, say, September 13th to trigger a capital gain. But it's still better than, I guess we'll say, the 8% increase you would get once you get into January, because it's an additional 3%. So basically you could save yourself 3% if you're looking at a $5 million or more income in the year. So it's a tricky one for sure, and a great question to ask.
I think the timing issue also, like David and I was talking to you about this, when we're doing a ton of healthcare transactions right now. And a lot of people rush to kind of get them done, or they're still trying to get them done by the end of the month and whatever, because they're trying to lock in the better rate on the capital gain. And, as it gets pushed out, I mean, everybody's trying to, we're going a little crazy with transactions because people in their minds, I think, are still thinking that it's not going to change maybe till the end of the year. So they want to get all these deals done. But it's really hard, from a planning perspective, whether it's income tax or transactions, for this uncertainty to be out there, because you just don't know what the implications of a particular deal are going to have on your client. It's just hard to even give them advice on that.
It is. And so what it really leaves me to is just, and this is probably the big takeaway I always leave everybody with, is we have uncertainty and we try to navigate, and there's things we can try to do and try to guess where things might go. But the best approach is really to understand what's happening, and then model what you can. So when I'm doing modeling for M&A transactions, I've got a column for, this is what the law is today, this is what it might be. Maybe these are some of the other proposals that are floating out there if you want to go down that road. And so that way you can make an informed decision with the best knowledge you have, even if it's a bit incomplete, because, there's uncertainty.
Yeah, are there going to be any changes in 199A that are going to adversely affect a lot of people?
Yes, and that's a great one as well. And maybe doesn't impact some in the healthcare space quite as much, but so 199A, the 20% deduction or qualified business income deduction, or whatever you want to call the thing, it's sometimes called the pass-through deduction. There've been a couple different proposals to we kind of rein it in. Where the House proposal comes is, it says, okay, well, we're going to cap it and say that a married individual filing separate, or somebody that's single individual, they would have a $400,000 maximum 199 cap A deduction. So it's 20% of your qualified business income deduction, or business income, that is, you get this deduction for. I always say it's like getting 20% off of the store. It's a great deal, right? I mean, it takes your current top rate of 37% down to 29.6%. Again, so that's great. Again, if you qualify, and a lot of times in healthcare, you don't, because it's one of those industries, kind of like accounting and CPAs over here, where once you get over income thresholds, you no longer are able to get the deduction. Well, that cap of the $400,000 max would be $500,000 for married filing joint taxpayers. So yes, that one certainly adds to. And so again, when I go back to the cost that's going up and the rates that go up, that certainly layers in. You have to factor that in. If you're a business owner, closely held business owner, and you're seeing all these things stack up, that adds another 20% to your rate effectively.
Yeah. There's going to be a lot of our clients are concerned about the changes that are proposed to the estate and gift tax rules.
Sure, certainly.
And we're doing a lot of planning for people before the end of the year, in the event that they do cut back the exemptions earlier than 2026. And I guess what I've seen is a discussion that if they would trim down the Build Back Better, I have to say that fast 3 times.
Tongue twister, isn't it?
if they cut it back below $3.5 trillion to something lower, that the thought is that they would get rid of some of these more exotic changes, like getting rid of the step up in basis of death. But it seemed like the things that are going to be left that have the best chance of getting passed are things like a reduction in the exemption and changes in some of these rules as far as discounts on gifts and on the use of defective grantor trust and grants. So I just use a lot of lingo in there, but if you want to talk about some of those new limitations and how they might affect people.
You got it. And it's like the one joke that estate planners have, right? Is that, you're throwing around a lot of 4-letter words there, David.
Right.
So bringing 4-letter words into the conversation about taxes, but I can't resist. Like it's like low hanging fruit, whatever you have, slats and grats and idiots right. And all that. Right. So, but yeah, absolutely. It's something to be looking at and planning for. And so the number one thing I always say when it comes to estate planning is today is if it makes sense to do it, today is as good of day as any to do it. There aren't a lot of downsides to moving forward with the plan, unless it's the wrong plan and it doesn't fit with, your vision for your family or your legacy or whatever it is. So that's where a lot of the hard work, I think, happens. And David, you know this, I'm sure, far better than I do in estate planning, is making sure that you're thinking about what are your wishes and is it aligned between you and your spouse, and what do you want for your children, and so forth. So there's a lot of that has to get done in making sure that whatever you do, the tax is great and tax savings is great. I certainly love talking about it and planning for it and executing on it. But if if it's not going to fit you and your family, that's first and foremost. And so getting that ball rolling, even with the time frame that we have, may honestly be pretty challenging to do if you haven't actually started some of those conversations right. And started doing some of maybe the basics in estate planning. Would you agree with that, David?
Yeah, I think that we're concerned that there's not going to be enough time before the end of the year for people to give some consideration to the decisions they would have to make. That's as right. Well as getting the documents drafted and getting the plan implemented. Because if you're going to be having a strategy where you're going to be making large gifts, besides the structure of the transaction, the documents have to be drafted and the gifts have to be made before the end of the year. This is not something you can say, okay, well, we'll sign the documents now and we'll get around to putting the assets in next year.
Yeah.
The fox will already be in the hen house by that time.
You're absolutely right.
January 1 of 2022.
And it may not even happen until the end of the year, because this right. is one of those interesting provisions on the yes. changes to grantor trust, right? To your point of that, and this was one of the surprise things when you have a lot of times I get a lot of questions, so I like to talk about the questions I get and the answers I give. So the question, well, what surprised you about this legislative text that was released, in the House? So, well, the one on grantor trust, it kind of caught me off guard a little bit, and that would have a effective date as of the enactment date. So, if President Biden were to sign it tomorrow, he's not, because we're not there yet in the process. We've got a long ways to go yet. It would be effective immediately, and basically at that point in time, anything you do with your grantor trust, which it's a type of trust, and I know trust can be confusing and overwhelming, but it's a very specific type of trust where you're treating it and owning it for income tax purposes, but not for transfer tax purposes.
Right.
So
You give it, it's a gift. It's a completed gift for gift tax
right.
purposes.
That's right. Yeah. So it's a very powerful technique
Yes.
when used properly and can be very effective in estate planning. Well, the proposal that's out there effectively would remove that. So you wouldn't be able to do that anymore. So spousal lifetime access trusts, which are commonly being used, and some of the other varieties, even life insurance trusts,
Exactly.
would be impacted by this. And so, there's certainly a lot of people that are trying to wrap their head around what it might be. And, is normally the case with legislative text and proposals. And even once they get enacted, you need some regulations. That's the role that Treasury plays and IRS play in being able to help us understand what these things mean. And we would need some of that. And so, assuming it were to get enacted, we would still even need guidance to fully understand what it means. But basically, it's, the message I've been sending is get going again, because maybe there isn't enough time left on the clock to get it done. Because again, if we're talking, they're talking in the end of October, so November, so that's not a lot of time to get these things in place. So definitely it's have the conversation, get your work with an estate planning attorney. Hopefully you have one. If you don't, I think David here would be happy to help, I'm sure. So line that up, with that.
If he has time.
He has time, because that is a good point. I should probably pause on that, right? I mean, it's a very busy time, is it not?
Yes. October has been like December.
Yeah. It is very busy time, because I think, everyone's sort of realizing that maybe we've got this limited time to take advantage of this opportunity. So it's get it done. But again, let's work with your kind of all your team of advisors. I think you definitely, when you're looking at certain varieties of these grantor trusts, you want to model them. And again, particularly if you have an operating business in there, inside the trust, that is, in terms of what the cash flow is going to be like, and how is this going to work, and really modeling it. That and I use that word modeling again. I think that is the key thing to do, especially in times of uncertainty. And so that way, when the time comes, we know what we're dealing with. We see that, okay, it's looking like it's going to pass, and this is what's going to be in it. Well, you've already done the work to have a sense for what it would be, and you can feel comfortable then pulling a trigger to say, you know what, I'm going to go ahead and move forward with it. Maybe you got that spousal lifetime access trust drawn up, and you knew kind of what you were going to put into it. You had all that kind of lined up, but you said, okay, well, maybe I'm going to wait and see what happens here in the next couple of weeks to see if this thing actually moves forward. Well, then at that point in time, because you've done all the work, you've got the document in place, you've got everything ready to go, except for the signatures and the modeling and all that. Well, now you could say, okay, I feel comfortable pulling the trigger on that because I ran the numbers.
Yes.
Great. Well, I guess one question I have, and I'm much more a lay person at this topic than you guys are, but we hear about the idea that the Democrats generally want to tax the rich, so to speak, right? And that this is kind of an effort to get those taxes from the people that can afford it, that haven't been paying their share, so to speak. And, if I'm misquoting anyone, I apologize. But what is your sense of whether this achieves any of that? 400,000, is that really the right mark to be using for that? Is this really what this is about, or are these kind of the standard back and forth tug of war between the two parties? Whenever somebody comes into office, they want to change the tax situation. So what does this really speak to?
Yeah, that's a really great question. Yeah, go ahead, David. Did you have...
One thing I think you have to keep in mind that a lot of the provisions that are in the Democrats' proposal aren't new. They've been introduced a number of times in the past. The repeal of step-up in basis, elimination of discounts for gifts of limited partnership interest or minority interest in businesses. Those are not new ideas. I think Senator Sanders has introduced that legislation for the last 2 or 3 sessions of Congress. Just hasn't gone anywhere.
Right. It's always been the Democrats, though, who's introduced it?
For the most part, yes. But the idea is that the more you get, after it becomes, the idea, I think, is that the more you hear about it, maybe the less onerous it will appear, and people get used to it. So I think that that's one thing you've got to keep in mind, that these things, if they're not enacted this year, it's not like they're going to go away and nobody's ever going to hear about them again.
Yeah.
So in answer to your question, the Democrats have historically been the party that has been in favor of tax increases and I think more spending.
Right.
I think that the other thing I think you see that for people who have estates of $10 to $15 million, the lifetime exemption is important. 6 million versus 11 million or 11 million 7 is a huge saving in estate tax for them. For people, the super wealthy, if you would, who have estates of $100 million and up, for them, whether the exemption 6 million or $11 million, that's okay. But the other changes that they're talking about making are going to generate much more tax liability for some of those people than just a change in the exemption. So that's where you're going to see, I think, pressure from lobbyists like the life insurance industry. I'm sure is going to want to try and keep irrevocable life insurance trusts viable. And other lobbyists for high net worth individuals or businesses are going to be actively involved in trying to protect those clients' interests.
Yeah.
And so you got things that, you know, you just can't look at it in a vacuum, and there's a lot of pressures going on that if you're in Washington inside the Beltway, you probably see, but outside it, all we know is what we read in the paper and hear on the TV
But
and radio.
When we talk about doctors and dentists, I mean, we're really talking about a range of income, typically somewhere between 200 up to around $1 million at the highest earning type positions, right? I mean, you have doctors below 200. You've got a lot of primary care who really are not earning that much. We've got nurse practitioners who are more maybe in the 100 or so type range. So that's really what we're talking about, up to $1 million. So is this taking money away from them in a more significant way than it has in the past? I don't think, I mean, there are certainly some of them that are super high wealth individuals, no doubt about it. But the majority of them are just hard workers, right? And they're earning a nice income, but they are considered that 1%, which, is a little surprising when it's only up to $1 million, that's the 1%. But how are they impacted? I really want, the people listening to understand, what does this mean for them? Is this an okay change? It won't seem that different to them? Or is this something really significant that they should be out there, talking to their representatives about?
I guess what I'd say is, that's where, not to use the M word again, but going back to that modeling, there really isn't a one size fits all for me to tell you, is it all good or all bad for you? Again, certainly if you're below the 400 threshold, they're really trying to go out of their way to make sure it doesn't impact. Now, there's certainly those that argue that, if you're changing rates above that has a kind of a trickle down effect. And, there's those in the, especially in the Beltway that, can look at the tax policy and the economic policy reasons for and against any sort of tax policy. But at the end of the day, what as a physician, right, or somebody in the space, you want to know, what's it mean for my bottom line in my pocketbook? Well, that's where you need to, work with your advisor to figure out, what are my circumstances? What does it look like for me? What am I doing right now? And then maybe look out a couple of years and say, well, what do I project in terms of income or gains that I might expect or things of that nature? And that way you can kind of figure out how this might impact. And I should also say, and David, you bring up a great point with the lifetime exemption, and that going down from we'll call it, 11.7 million today down to the inflation adjusted 5 million. So we'll call it 6 million. If you don't have an estate that's above that threshold, and really have to multiply that number times 2 if you're married, because each person gets that lifetime exemption either during their life or at death. And so you're really, for a married couple, you're looking at, we'll call it $24 million roughly right now to have an estate tax problem, so to speak, where you would need to be doing the sorts of things where we're using those slats and the grats and the nature, right? Because if you're below that threshold, that's not really the type of strategies you'd want to be using. But now that number is going to come down because you'd be getting cut in half. So more people, again, maybe to your point, we have to start looking at that and considering that and look at some of those estate planning techniques. And then you also have to look at some states including Illinois, where I reside, does have a state level estate tax that actually has a lower threshold. So it's really looking at your individual situation to know how it's going to impact you and to know what side of that coin you're going to land on.
And the other thing, we've been talking about the revenue raising part of the
Mhm.
Biden proposal, and you have to look at what the benefits of the law might provide to you as a taxpayer. Child tax credit, child care tax credit. Does that offset some of the negatives? So maybe for you, this is really, maybe you pay a little bit more in taxes. You'll get the state and local tax, real estate tax deduction back. You'll get child care tax credit, maybe some other things that'll be beneficial to you. The Trump tax cut, I think for a lot of our clients, the Trump tax cut didn't really help them any. In terms of an income tax standpoint, it actually cost them money, and because of the loss of the ability to deduct taxes in excess of $10,000.
Yeah, that state and local tax cap is definitely well, it's in the conversation too. It's not in the House proposal right now, but that's probably a good point to mention there, David. Right? That maybe there's a 2-year repeal that comes back in and allows you to deduct those state and local taxes, or a number of the states have actually enacted. I think we're up to either 18 or 19 states now that have a so-called SALT cap workaround that allow you to deduct the states. So that you're right. There's no one size fits all, and you kind of have to look at your situation, how you're getting the income. Is it a W-2 and your wages that you're getting? Is it a Schedule K-1 as a shareholder in a medical corporation or a partnership interest? It all depends and factors into how this will impact you.
Oh, I think that's really helpful. All right. So are there any final thoughts on this topic that you want to share? Either one of you?
Yeah, I don't know. There's a lot. I feel like how much time do you have?
Well, you know what? I'm going to make sure that your link is out there when we put this podcast out there. I mean, obviously, we can only touch the very surface of these issues, and I really encourage anyone listening out there. You've heard it from Damien and David now, that you need to know your individual situation, and you need to talk to somebody about how you could be impacted and plan for that. So we can't obviously address all those situations here, but I think people can see that there's a lot they don't know, and they need to talk to somebody who does know. And I think that's what I really take away from hearing both of you talk about this.
And I think it's important that people do this sooner rather than later. You always hear the accountants say, well, somebody showed up on April 14th with a shopping bag full of receipts.
Right.
That's hard. That maybe you can get a tax return done, or you get an extension filed. There's not likely to be any mulligans on estate tax planning and gift tax planning if the law does change. So I think that you've got to leave yourself sufficient time to learn about what might be appropriate in your situation, and give yourself time to make a decision on how you want to proceed.
Yeah, I think that I mean, I 100% agree, David. And I think that time is your friend when it comes to this sort of thing and these sorts of conversations. And the real reason is its flexibility, because we don't know, like I said, what the crystal ball really has in there for us here on what it'll look like. So you want to be able to consider them, and then give yourself all the options that you have, and showing up the day before the deadline, so to speak, with your shopping bag, which, as a guy that does taxes, I may have seen that a time or two, even to this day, of that approach, and so, that really doesn't work as well here. So if you're trying to make the most informed decision, trying to make the best decision, having that on your side is the best. Exploring all your options, again, to say that, repeat that model word again. I feel like modeling is so valuable there. And you would do it, especially if you're looking at an M&A transaction or something. You want to model because it's oftentimes it's the most significant asset sometimes that you have. You want to make sure that you're doing the right thing. So you want to model, and you want to keep your options open. And probably the last point is, just be careful, because there are some comments that float around sometimes on the internet or TikTok or whatever you want to, wherever you might find your tax news. Just be warned that there is some things are fast moving, and whenever that happens, there's some misunderstandings or misinformation, or maybe even it's just out of date. because, these things are changing so quickly that an article written 6 months ago is not the same as an article written 6 days ago. So you definitely want to keep that in mind. So I guess a couple points there. I don't know how many it was, but I couldn't just keep it to one.
Well, I think you did a great job. And I guess the most important thing is that you need to surround yourself with people who are up to date on this information and make sure that you are working with someone who is familiar with the most current developments out there. And I think that's what you're trying to say. There's lots of disinformation out there on any topic right now. So this is one of those ones where you could really get hurt if you're not talking to an expert in this area. So, well, thank you very much for joining us, everybody, today. And Damien Martin, what an excellent guest. We hope you'll come back and join us again. You'll be able to find out more about him and about BKD when we post this podcast. And feel free to reach out to Damien with any questions that you have. We thank you for joining us, and we thank everybody out there for coming to listen to the Health Law Hotspot. We hope you'll check out some of our other podcasts at ralaw.com, and feel free to reach out to any of us. We look forward to hearing from you. See you next time.
The Roetzel Health Law Hotspot is made available by the firm and its attorneys for educational purposes and to provide general information, not to provide specific legal advice. Use of the Roetzel Health Law Hotspot does not create an attorney-client relationship between you and the firm or any of its attorneys. The Roetzel Health Law Hotspot should not be used as a substitute for competent legal advice, and you should contact an attorney in your state about any legal needs or questions you may have.